rate arbitrage is the practice of taking advantage of the interest rate differential between two countries by borrowing in one country at a low interest rate and simultaneously investing in another country at a higher interest rate. This strategy can have implications on the balance of payments, war, exchange rates, and global inflation. If the interest rate differential between two countries is significant, investors may borrow in the country with the lower interest rate and invest in the country with the higher interest rate. This can lead to capital outflows from the low interest rate country and capital inflows into the high interest rate country, which can impact the BOP of both countries. The low interest rate country may experience a balance of payment deficit, while the high interest rate country may experience a surplus. Interest rate arbitrage can also impact exchange rates. If investors buy the currency of the high interest rate country to invest in its higher yielding assets, this can increase the demand for that currency, leading to appreciation. On the other hand, if investors sell the currency of the low interest rate country to finance their investments in the high interest rate country, this can lead to depreciation. Furthermore, interest rate arbitrage can impact global inflation. If investors borrow in a country with a low interest rate, they can access cheaper capital, which can increase their spending and potentially lead to higher inflation. Conversely, if investors invest in a country with a high interest rate, this can lead to lower inflation due to increased investment and production. Recent examples of interest rate arbitrage include the Japanese yen trade, where investors borrowed in yen at low interest rates and invested in higher yielding assets in other countries, such as US Treasury bonds. Another example is the Eurozone, where the European Central Bank's low interest rate policy led to capital outflows. This increased investment in higher yielding assets in other countries, such as US stocks. In summary, interest rate arbitrage is a strategy that can impact the BOP, exchange rates, and global inflation, depending on the interest rate differential between countries. Recent examples demonstrate its impact on financial markets and the economy.